Today we're going to begin chapter 16. 16 covers financial statements and closing entries for a corporation. Lesson 1 is preparing an income statement. Our learning objective for today is we're going to prepare an income statement for a merchandising business that's organized as a corporation. The uses of financial statements, there's two. A corporation prepares an income statement and a balance sheet similar to those used by a sole proprietorship. A corporation also prepares a statement of stockholders' equity. This is similar to owner's equity. When we prepare an income statement, we start with a trial balance. So the trial balance has all of our assets, liabilities, and equity. And then we do our adjustments, and then we transition into an income statement. Operating revenue section of an income statement for a merchandising business. The revenue earned by a business from its normal business operations is called its operating revenue. The amount of sales less the sales discounts, which is reductions in the sales price, or sales returns and allowances, which is inventory or merchandise or any sale item that was not wanted or discarded. That's going to be your net sales. Operating revenue continued. So this is what it's going to look like on the income statement. We've got 9 parts. First, you're going to write the income statement heading. It's 3 lines. Then you're going to write the name of the section, which is operating revenue. Then you write the title of the revenue account, which is sales. You're going to write the correct amount, which is $632,371.75. And then you're going to write less, because what we're going to subtract out is the sales discount and the sales return and allowances. On step 6, you're going to actually write the amount of the sales discount and the amount of the returns and allowances in the second column. So you're going to tab over. On step 7, you're going to add the sales discounts and the returns and allowances. This is going to give you $55.89.76. On step 8, you write net sales, and then step 9, you go ahead and subtract. This is going to be the full amount for your net sales. The original price of all merchandise sold during a fiscal period is called the cost of merchandise sold. The cost of merchandise sold is also known as goods sold or the cost of sales. The operating revenue remaining after the cost of merchandise sold has been deducted. That's going to be your gross profit. And gross profit is often referred to as gross profit on sales, or the money you make from sales. So when we're filling out the cost of merchandise sold portion, we have 8 steps. In step 1, you're going to write cost of merchandise sold. It's the title. Step 2, you're going to write what's your beginning inventory. So this is going to be the amount that you have on January 1st of that given year. Step 3, you're going to prepare the purchases section. So you're going to write how much was purchased during the year. Then you have less your purchase discount and your purchase returns and allowances. You're going to tab over and fill in the amounts for purchase discounts and the amounts for purchase returns and allowances. And you're going to combine those, then subtract it from your total purchases. This is going to give you what's called net purchases. On step 4, you're going to calculate the total cost of merchandise available for sale. In order to do that, you're going to add the beginning inventory and the net purchases. And that's going to be the total cost of merchandise available for sale. On step 5, you're going to write the amount of the ending inventory. This is going to be found in the adjusted trial balance. You'll indent and go on the next line, and this is going to be less merchandise inventory. Now this is going to have the date of December 31st. You're going to write the ending merchandise inventory, and again, that's from the adjusted trial balance. On step 6, you're going to calculate the merchandise sold. So you'll indent once again, and this will be cost of merchandise sold. To do this, you're going to subtract the ending merchandise inventory from the total cost of merchandise available for sale. Step 7 will be to calculate the gross profit. You'll write the gross profit, and in the 4th amount, you'll subtract the cost of merchandise sold. And this is going to give you your gross profit. So step 8 is to prepare the vertical analysis. So our net sales is our 100%, and you're going to take your cost of merchandise sold divided by net sales to figure out your percent. In this case, our percent was 41.2. Then you're going to take your gross profit and also divide it by net sales, and that's going to give us a percent of 58.8. This is just continuing with the sales discount and then the total of the adjustment column. The expenses incurred by a business in its normal operations are called operating expenses. The operating revenue remaining after the cost of merchandise sold and operating expenses have been deducted, that's called the income from operations. Income from operations is also called operating income. To complete the final portion, we've got just a few more steps. So we're going to now do the operating expense portion, which is step 1. We're going to write the title of operating expenses, and then we're going to write all the expense account titles, and we're going to write the corresponding amounts. Then we're going to calculate the total operating expense, so you're going to actually sum that up. The total individual expense amounts we're going to write on one tab over. On step 2, you're going to calculate the income from operations. So you're going to write the amount, and basically this is the gross profit less the operating expenses, and this is going to equal income from operations. On step 3, you're going to prepare the other revenue section. So under other revenue, this is where that interest income comes into place with those notes payable. Again, this is additional income that's come in after a sale was on account and we extended time for them to pay. Step 4 is going to be to calculate the net income before the federal income taxes. So we're going to write that amount, and again, this is income from operations plus other revenue, and this is going to equal income before federal income tax. Step 5, we're going to write less federal income tax expense. Step 6, we're going to actually calculate the net income after the federal income tax. So we're going to write down the net income after federal income tax title, and then the amount. The net income before federal income tax is less the federal income tax expense, and that's going to give us our net income after the federal income tax expense. 7, you're going to rule double lines, which the system will do for us. And then step 8, you're going to prepare your vertical analysis. So we're going to again divide by net sales to calculate the percents. So you're going to do the total operating cost over net sales, income from operations over net sales. You're going to do interest over net sales, net income before over net sales. And then you're going to do the federal income tax expense over net sales. And finally, net income after federal income tax over the net sales. So again, everything is constantly being divided by the net sales column. So audit your understanding. What's the major difference between income statements for merchandising businesses and service businesses? The main idea is this cost of merchandise sold section. This is the new part. How is cost of merchandise sold? Well, you have your beginning inventory plus your purchases, and that's going to equal total cost of merchandise available for sale. Then you're going to subtract your ending merchandise inventory, and that's going to equal the total cost of merchandise sold. Why is interest income presented in a section other than operating revenue? Well, the interest earned on notes receivable is not a normal operating activity. Again, this is a courtesy that we extend to our clients when they cannot pay on time. And this is the PowerPoint note, so we're going to go ahead and get into our actual work together.